Today, we're uncovering the secrets of the Federal Reserve, commonly known as the Fed, which is the central banking system of the United States. The main power of the Fed lies in its control over the federal funds rate, the interest rate at which banks lend their money to each other overnight. Changes in the federal funds rate have significant effects on the global economy, which we will showcase in this video. Welcome to another episode of Visual Economist on how the Fed's interest rate policy impacts the world economy. The task of determining interest rates is shared between two organizations: the Board of Governors of the Federal Reserve, referred to as the Board, and the Federal Open Market Committee, FOMC. The Board is in charge of making decisions concerning changes in discount rates, the interest rates commercial banks have to pay to borrow funds from the Federal Reserve. Conversely, the main responsibility of the FOMC is to set the target range for the federal funds rate, which is the interest rate at which commercial banks lend money to each other for less than a day. The FOMC uses changes in the federal funds rate to achieve its dual mandate of promoting maximum employment and stable prices. Now let's see how the changes in the Fed's interest rate policy impact the global economy. The global financial markets. When the Fed changes interest rates, it affects the attractiveness of US assets, including bonds and equities, for investors worldwide. If the Fed raises interest rates, US assets tend to offer higher returns, leading to increased demand from foreign investors. As a result, foreign capital flows into the US, strengthening the US dollar and potentially leading to capital outflows from other countries. For instance, during periods of rate hikes, emerging markets may experience capital flight as investors seek higher returns in the US. To demonstrate the impact of the Fed's interest rate hike on the financial markets, let's examine the performance of the 10-year US Treasury note from the end of 2021 until mid-2023. Initially, it yielded just 1.5%, indicating a consistent trend of lower interest rates. However, as the Fed began increasing interest rates in 2022, yields experienced a significant surge, reaching a peak of over 4% in July 2023, a level not seen in more than 10 years. The foreign exchange rates. When the Fed raises interest rates, it tends to strengthen the US dollar relative to other currencies. From January 2021 to June 2022, the DXY, the US dollar index, surged by more than 15%, reaching its highest level since December 2002. A significant portion of these gains occurred in March and April 2022, which coincided with the Federal Reserve's decision to raise interest rates by 25 basis points in March and by 50 basis points in May 2022. A stronger dollar can have both positive and negative effects on different economies. For example, it may benefit importers in the US as they can purchase goods from abroad at lower prices, but it can hurt US exporters as their goods become relatively more expensive for foreign buyers. Commodity prices. Interest rate policy can influence commodity prices and affect the revenues of commodity exporter nations like Brazil or Russia, as many commodities are priced in US dollars. For example, the export revenue from soybeans in Brazil declined by approximately 25% between 2014 and 2015 due to the strengthening of the US dollar. Global borrowing costs. The Fed's interest rate decisions influence global borrowing costs since many countries and corporations around the world borrow in US dollars. When the Fed raises interest rates, borrowing in dollars becomes more expensive, potentially impacting emerging markets or countries with high levels of dollar-denominated debt. During the 2008 financial crisis, as the Federal Reserve raised interest rates, many subprime mortgage borrowers found it increasingly challenging to afford their mortgages. This led to an oversupply of houses, surpassing the demand, resulting in borrowers defaulting on their mortgages. Global economic growth. The Fed's interest rate policy can indirectly impact global economic growth through its influence on the US economy. As the world's largest economy, changes in the US interest rates can affect consumer spending, business investments, and overall economic activity. When the Fed raises rates to cool down an overheating economy or control inflation, it could lead to reduced global demand for goods and services from other countries that heavily depend on exports to the US. Overall, the Federal Reserve's interest rate policy has far-reaching implications for the global economy, influencing financial markets, exchange rates, borrowing costs, commodity prices, and economic growth across different nations. As a result, central banks and policymakers worldwide closely monitor the Fed's decisions and consider their potential impact on their economies. We hope you found this video insightful. Thank you for watching, and as always, don't forget to leave a comment and subscribe to our channel. We'll see you again in the next video.